Imagine a world without a reliable hand guiding the economy, where financial panics and bank runs are everyday scenarios, throwing the lives of people into financial chaos. This was the reality of America in the early 20th century, a time when economic turbulence could erupt without warning, leaving devastation's sight. The Federal Reserve, often covered in mystery and misunderstood by many, emerged from this turbulent backdrop as the guardian of the nation's financial system. Its creation marked the beginning of a journey to stabilize and safeguard the U.S. economy, a journey filled with challenges, triumphs, and controversies. As we explore the history and evolution of the Federal Reserve, you'll learn about the fascinating story of how this institution has shaped our economic landscape. From its origins in the aftermath of the Panic of 1907 to its pivotal role in modern monetary policy, the Fed's influence extends far beyond the walls of its imposing headquarters in Washington, D.C. Whether responding to crises, managing inflation, or adapting to new financial technologies, the Federal Reserve stands as a shield against economic instability. Make sure to stick with us as we explore the unknown operations of the Fed, revealing the critical decisions and dramatic moments that have defined its legacy as the guardian of the economy. In the early 20th century, America was a land of boundless opportunity and rapid industrial growth. However, this era of prosperity was frequently interrupted by financial panics that wreaked havoc on the economy. These panics were like storms on the horizon, dark clouds that could turn a sunny day into a nightmare for banks, businesses, and everyday citizens. The Panic of 1907 was particularly severe, almost bringing the nation to its knees. It was clear that the country needed a more stable financial system, one that could weather economic storms and keep the ship of state on an even keel. You have heard of J.P. Morgan, the towering financier whose influence over the American economy was immense. Morgan orchestrated a bailout during the Panic of 1907, gathering fellow Wall Street bankers in his opulent library and spearheading a plan to save the banking system. However, even Morgan's vast resources couldn't be relied upon to save the day every time. The panic revealed an obvious need for a central banking system. In 1908, Congress established the National Monetary Commission to study European central banks and propose solutions to prevent future crises. After several years of intense debate and planning, the Federal Reserve Act was signed into law by President Woodrow Wilson on December 23, 1913. The act established the Federal Reserve System, a network of 12 regional banks overseen by a central board of governors. This new institution was designed to provide the nation with a safer, more flexible, and more stable monetary and financial system. The creation of the Federal Reserve was a watershed moment in American history, laying the foundation for a century of economic management. The Federal Reserve System, often referred to simply as the Fed, is a complex organization with a unique structure. At the heart of the system is the Board of Governors, located in Washington, D.C. This 7-member board, appointed by the President and confirmed by the Senate, sets crucial policies and oversees the entire Federal Reserve System. Each governor serves a 14-year term, a tenure designed to insulate them from political pressures and ensure their decisions are made in the best interest of the economy. Surrounding the Board of Governors are 12 regional Federal Reserve banks, each serving a specific district of the United States. These banks operate independently within the framework of the Federal Reserve System, providing financial services to commercial banks, the U.S. government, and the public. They are like the arms of an octopus, reaching into every corner of the nation to implement the policies set by the Board of Governors. Each regional bank has its own president, selected by a board of directors drawn from the private sector, ensuring that local economic conditions are considered in the Fed's policy-making process. The Federal Reserve's responsibilities are vast and varied, encompassing several key functions. Firstly, it conducts monetary policy to manage inflation and employment levels. By adjusting interest rates and influencing the money supply, the Fed aims to maintain price stability and promote sustainable economic growth. Secondly, it oversees and regulates banks to ensure the safety and soundness of the nation's banking and financial system. Thirdly, it provides financial services, such as clearing checks and processing electronic payments, to depository institutions, the federal government, and foreign official institutions. These functions make the Fed an indispensable guardian of the economy, standing ready to intervene whenever stability is threatened. Monetary policy is perhaps the most visible and impactful role of the Federal Reserve. At its core, monetary policy involves managing the supply of money and the cost of borrowing money, interest rates, to achieve macroeconomic goals. The Fed's primary tool for conducting monetary policy is the Federal Open Market Committee, FOMC, a 12-member body composed of the 7 governors and 5 regional bank presidents. The FOMC meets regularly to assess the economic landscape and decide on the appropriate stance of monetary policy. One of the most powerful tools at the Fed's disposal is the federal funds rate, the interest rate at which banks lend to each other overnight. By lowering the federal funds rate, the Fed makes borrowing cheaper, encouraging spending and investment. Conversely, by raising the rate, the Fed can cool down an overheating economy and keep inflation in check. These adjustments can ripple through the economy, influencing everything from mortgage rates to business loans to consumer credit. The Fed's actions on interest rates are closely watched by financial markets, businesses, and consumers, all of whom react swiftly to any changes. In addition to manipulating interest rates, the Fed also uses open market operations to control the money supply. This involves buying or selling government securities in the open market. When the Fed buys securities, it injects money into the banking system, increasing the money supply and encouraging lending and investment. Selling securities has the opposite effect, pulling money out of the system and tightening credit conditions. These operations are a key part of the Fed's toolkit, allowing it to fine-tune economic conditions and steer the economy towards its goals of maximum employment and stable prices. The true test of the Federal Reserve's mettle comes during times of economic crisis. One of the most significant challenges in its history was the Great Depression of the 1930s. The stock market crash of 1929 set off a chain reaction of bank failures, skyrocketing unemployment, and plummeting economic output. Initially, the Fed struggled to respond effectively. Its policies were often too tight, exacerbating the economic downturn. However, valuable lessons were learned from this period, leading to significant changes in the Fed's approach and the broader financial system. Fast forward to the 2008 financial crisis, and the Fed's response was markedly different. As the housing market collapsed and financial institutions teetered on the brink of failure, the Fed acted swiftly and decisively. Under the leadership of Chairman Ben Bernanke, the Fed slashed interest rates to near-zero levels and launched unprecedented measures like quantitative easing, where it bought large quantities of government and mortgage-backed securities to inject liquidity into the economy. The Fed was forced to implement 10 interest rate cuts, bringing the Fed funds rate down from 5.25% to essentially zero. These actions helped stabilize financial markets and set the stage for a gradual recovery. More recently, the Fed faced the economic fallout of the COVID-19 pandemic. In early 2020, as the virus spread globally, the Fed again moved quickly to support the economy. It cut interest rates to near zero, expanded its asset purchase programs, and implemented new facilities to support credit flow to households, businesses, and municipalities. The Fed's rapid and robust response helped to cushion the economic blow and set the stage for a strong recovery as vaccines rolled out and restrictions eased. These episodes highlight the Fed's critical role as a stabilizing force in times of economic turbulence. Despite its crucial role, the Federal Reserve has not been without its share of controversies and criticisms. One major point of contention is the Fed's independence from political influence. While this independence is meant to ensure that monetary policy decisions are made based on economic considerations rather than political interests, it also means that the Fed operates with a high degree of autonomy. Some critics argue that this lack of direct accountability can lead to decisions that are out of step with the needs and desires of the broader public. Another common criticism centers around the Fed's handling of inflation and employment. Balancing these two mandates can be challenging, and there have been times when the Fed's actions have been blamed for either stoking inflation or failing to address unemployment adequately. For example, during the 1970s, the Fed struggled to combat stagflation, a period of high inflation and stagnant economic growth. More recently, some critics have argued that the Fed's prolonged low-interest rate policies have contributed to asset bubbles and increased financial instability. Additionally, the Fed's role in bailing out financial institutions during the 2008 financial crisis sparked significant debate. While these actions were intended to prevent a complete economic collapse, they also led to accusations of favoritism and moral hazard. Critics argued that by rescuing large banks and financial firms, the Fed was effectively encouraging risky behavior, as these institutions could expect to be bailed out again in the future. These controversies underscore the complex and often contentious nature of the Fed's role in the economy. The influence of the Federal Reserve extends far beyond the borders of the United States. As the central bank of the world's largest economy, the Fed's policies have a significant impact on global financial markets and economies. When the Fed adjusts interest rates or engages in large-scale asset purchases, the effects are felt worldwide. For instance, lower U.S. interest rates can lead to capital flows into emerging markets, seeking higher returns, which can drive up asset prices and boost economic activity in those regions. Moreover, the U.S. dollar's status as the world's primary reserve currency means that Fed policies play a crucial role in international trade and finance. Central banks around the world hold substantial reserves of U.S. dollars and U.S. Treasury securities. As a result, changes in the Fed's monetary policy can influence global exchange rates, trade balances, and the availability of dollar-denominated credit. During the 2008 financial crisis, the Fed established currency swap lines with other central banks to provide dollar liquidity and stabilize global financial markets. The Fed also collaborates with other central banks and international financial institutions to address global economic challenges. This cooperation was evident during the COVID-19 pandemic when central banks, including the Fed, coordinated their actions to support the global economy. These collaborative efforts helped to mitigate the risks of economic contagion and ensure that global financial systems remain stable. The Fed's actions demonstrate its vital role as not just the guardian of the U.S. economy, but a key player in the global economic landscape. As the Federal Reserve looks to the future, it faces several significant challenges and opportunities. One major area of focus is the evolving landscape of digital currencies and financial technology. The rise of cryptocurrencies and digital payment systems has the potential to transform the financial system, posing both opportunities and risks. The Fed is actively researching and exploring the potential for a central bank digital currency, CBDC, which could provide a safer, more efficient payment system while addressing concerns about financial stability and monetary policy effectiveness. Another critical issue is climate change and its impact on the economy. The Fed has begun to recognize the importance of incorporating climate-related risks into its economic assessments and regulatory frameworks. By understanding and addressing these risks, the Fed can help ensure the resilience of the financial system in the face of environmental challenges. This includes monitoring the potential impacts of climate change on financial institutions, markets, and the broader economy. Finally, the Fed must continue to navigate the complexities of a globalized economy. As international trade and financial markets become increasingly interconnected, the Fed's policies will need to consider not only domestic economic conditions but also global economic trends and developments. This will require ongoing collaboration with other central banks and international organizations to promote economic stability and growth worldwide. As the guardian of the economy, the Federal Reserve's ability to adapt and respond to these evolving challenges will be crucial in shaping the future of both the U.S. and global economies. Thank you for watching. If you enjoyed this video, be sure to click the like button and subscribe to see more videos just like this. If you want to learn even more about the Federal Reserve, be sure to check out Eustace Mullen's book, The Secrets of the Federal Reserve, in the video description below. Until next time, stay blessed.